Good morning, guys. It is a great pleasure seeing that so many of you could join us today for our fourth edition of online series on the agenda. My name is Anastasia Pravedna, and I'm a membership and strategy member at European Liberal Forum. For those of you who don't know us yet, we're a foundation and think tank of ALDE Party, so European Liberals, and we are member-based organizations, and we have 45 members who are based in Europe and beyond. So, banking union. At first, it seems like quite an abstract topic, right? Far away from the citizens. But let me share a very personal story with you. I was very lucky to live and study in a few European countries. And one of them was Greece, where I did my master's studies, where I studied, I lived, I had my banking account. Quite logical, right? And then I moved to Brussels, and then crisis happened, and very strict limits were imposed on how much money you can withdraw every day. If I'm not mistaken, I think it was like 60 euros, something like that. So it was crazy for me, right? Living in Belgium, in different European country, and I couldn't access my banking account because the Greek banking system collapsed. And this really made me think that without stable banking union, without EU regulation ensuring the stability of the national banking system, we cannot truly enjoy our rights as European citizens. And with this in mind, I would like to start our discussion today about the banking union and give the floor to our moderator, Beatrice.
Thank you, Anastasia, and thank you very much, everyone, for joining today. First of all, I would like to give you a few rules of working today. So first of all, you have to know that we are not only streaming the session through Zoom, but also through the social media of the European Liberal Forum, and also that you would have the chance to ask some questions. So if you would like to ask a question to our panelists, you would find a chat box in your page, and you could just type in your question, who you are and who you're addressing the question to. So today we're talking about the banking union. We've seen the process of completing the economic monetary union over the years. And one of the remaining big pillars of that economic monetary union is the banking union. We saw some progress at the beginning of this year and the end of last year, but then a pandemic came up. And all that progress at political level was somehow stuck. We would like to see where we are and where we are heading today. And for that, we have an amazing panel. I would like to introduce first Graham Bishop, who is an independent consultant and the co-author of the European Liberal Forum discussion paper, Banking Union, Imminent Crisis and Possible Solutions. So please, Graham, you have the floor.
Right, thank you very much. It's a great pleasure to be here. Yes, let's start with the, I have a slide here showing European bank shares, which I hope is going to come up on the screen. I want to make this clear that the European banking system is in serious trouble, and no one should doubt that. Now, is this chart on your screens? I hoped that it was going to be. Clearly it isn't. Right, Alexandra, can you put up my first chart, my first slide? Okay, well, in that, here we are. Right, aha, that's it, right, good. Okay, so this is the index of European bank stocks. Now, let's just be clear about the history. This started in the 1980s at 100. So over 30 years, third of a century, it's gone nowhere. At the height of the banking boom in the early 2000s, that index was up at nearly 500. So when it fell, it's come down a long, long way. And even this year, you can see it was just at 100 before the crisis struck, and then halved in the space of couple of months, and has recovered a bit, but is going nowhere. Now, the important point out of this is that at this very low level of bank shares, they are now trading at about 40% of their book value. So banks are not going to issue shares to anyone unless they're forced to. So this is the real problem why the banking regulators have relaxed a lot of the capital standards, is to allow banks to draw down their capital buffers so they don't have to ask their shareholders for new funds, because at the moment the shareholders won't provide it. They're very unlikely for the vast majority of banks. So the regulators can provide a certain amount of support and they can provide liquidity. The ECB has done that. But the big problem is the potential magnitude of the loan losses. Now, the ECB, in the single supervisory mechanism, is saying that the GDP should decline about 9% this year, and is giving that a probability of about 30%, a third. It could go as low as 13% decline, absolutely unprecedented. That's got a 9% probability. But in the middle, it's a 22% probability. And at the moment, I'm afraid we're heading towards that middle. Now, the ECB has said if their optimistic scenario, their central scenario comes to pass, then most banks, not all, but most banks should be okay and should be able to continue lending. But if you get to the extreme end of that scenario, then the drawdown of capital because of the scale of losses will be quite significant. And what we're already seeing is the loan losses being reported by European banks are much smaller as a percent of their assets, their risk-weighted assets, than American banks. And the major American banks are reporting something like 4%, 4 times bigger loan losses. Now, there's a reason for that. American banks have to report on different accounting standards. But nonetheless, European banks are beginning to report much smaller losses than were expected. This may change, but we know that the governments have made enormous sums available to the banks. Germany, for example, has said they're going to lend, or they're going to provide facilities of 760 billion euros. Actually, they've only dispersed 4% of that. Spain, at the other end of the spectrum, has said they would provide 183 billion of resources, and they've dispersed 42% of that, and everyone's in between. So these huge sums which are being offered by the governments, it's not actually being handed out to the companies and SMEs, etc. So we are in a situation where if these loan losses come through, they will begin to impact the bank's capital and bring it down to such an extent that there could be problems for some banks. And of course, it's always the weakest banks which are the problem. So the European Union is doing something about it. And of course, this is the Next Generation Fund, which is now promised for action, 750 billion euros and 100 billion offshore. Now, in my second slide, which I hope Alexander is going to put up, you can see there highly rated AAA bonds. You'll see the scale of what is proposed for the recovery fund with Shore. And if you actually add in EIB and ESM, which are all European, and I'm going to deliberately avoid Eurozone or EU, but European guaranteed entities, you're talking about the same size as the German government's bonds outstanding. But this is only going to happen over the next few years. Now, the comparison with the US, if you're talking about will the euro become a rival to the dollar, become internationally used to a much greater extent than it is today, the US is about 3 times this size. So for top-rated bonds. So if you want to have a banking union which is dependent on government bonds as a safe asset, then the US is providing much more of that for its own banking system, and the EU is not going to provide that much. And importantly, the recovery fund will come, I expect, we don't know yet, but I expect as mainly as long-dated bonds, going out to 2050, 58, I think, maximum. So that is a much longer maturity than you would expect banks to want to hold. It's great for life insurance, pension funds, and so on, match funding their liabilities. But this is not the solution to banks or for banks from the whole problem of a lack of a safe asset and the doom loop between the banks and their sovereigns. So if we then think about whether this recovery fund is a significant change, it is certainly not the Hamiltonian moment from the 1790s when the US states took over, accepted liability for the debts of some of the states. It is not that. It is a relatively modest step. The grants component of that is only half, so 50 billion euros. That's very small. So this is not a mutualization by any means of European debt, European government debt. The banking union, by contrast, if you finish up with the European Deposit Insurance Scheme, EDIS, if that does indeed mature eventually to something which which does guarantee citizens' deposits, households' deposits, they are 7.5 trillion deposits. So you can immediately see that's a much, much bigger scale of thing to make happen, to make EDIS happen. Now, just finally, is this likely to happen? Well, the steps, and I'm sure Diane is going to talk more about this, the governance steps for the Next Generation Fund were critical. We moved away from the idea of unanimity to a QMV for dispersing the funds. There is a possibility of a country to object, but in the end, if that objection is not upheld unanimously, the Commission's proposal goes through. This is a fundamental change, but is it that big when you're talking about 350 billion euros? Germany has changed, that's clear. Germany held out against anything when Greece at 2% of GDP had a problem. Germany now faces the problem. The whole of the Eurozone, the bulk of its exports face a problem. Something has to be done. Something has been done. Will it go the next step and take and provide EDIS as a real backstop to 7.5 trillion of customer deposits, household deposits? History will tell us. But some thoughts on why this is a very serious problem.
Thank you very much, Rakan. So my follow-up question would be related to what you mentioned before. We've seen a number of initiatives that have been trying to respond to the short-term impact of this crisis. With the tools that we have right now, leaving aside the fact that we definitely need to finalize the completion of the banking union, with the tools that we have right now on the table, be it the bond buying program from the ECB to the Next Generation EU, could we actually prevent the banking system of the European Union from collapse?
No.
Easy one, right?
Let me elaborate on that. There are laws in place which require, this is CRD4 and CRR, etc., and all these things, which require banks to have a certain amount of capital. The regulators can't avoid that, otherwise they will be challenged in court. So if the crisis becomes larger, as large as the ECB's worst case scenario, then it's not a question of liquidity to banks, it's their solvency. And they have to take losses which draw down their capital to below their minimum requirements for trading, and things have to happen. My central point is shareholders are not going to provide new capital. You could get an amount of capital from additional tier 1 capital, but all of this, it's a very specialized subordinated debt, but all of this requires investors to believe that the loan losses are manageable. The ECB at the moment is talking about a minimum of 300 billion of loan losses, but it could easily range up to 600 billion. But I look at the history of the 2007-8-9 banking crisis, which was only a 4% decline in GDP. So we're now talking about something which is at least twice and maybe 3 times as big. And at that stage, the loan losses, by the time they peaked in, I think it was 2014, had hit nearly 1 trillion. So if you talk about 1 trillion of loan losses appearing this time round, that is at least half of the bank's equity base. That is a big, big problem for the European banking system as a whole. There will be, of course, not every bank, these averages are averages. Some banks are much better than that, but some are much worse. And those are the problem banks where, as they say, the chain is only as strong as its weakest link.
We'll definitely talk about that, and how can we make sure that the system that we have in place is enough to face these consequences, and how are we getting to a debt crisis as well. But before, I would like to jump into our second panelist, who is Diane Fromage. She's an assistant professor of European law at Maastricht University. So please, Diane, you have the floor.
Okay, thanks very much, Beatrice, and also to the organizers for the invitation. I think while Graham's presentation ties very good with mine, which is more about the governance and how the management of the crisis that we're facing now compares to the one that we had with the great financial crisis, because I think, well, it's really important that we try and learn from the previous crisis and see what can be done. But well, to tie in with what Graham was saying, I think it's undoubtable that the crisis that we're facing is now putting the EMU governance that we have within the EU, and especially within the Eurozone, under a lot of pressure, and it called for a lot of reforms and deep-reaching reforms to be adopted very swiftly, but against a particular background in which, first of all, we were working remotely, and well, it's likely we will continue to work remotely, unfortunately, which doesn't make, you know, those complicating negotiations any easier. The EMU reforms that had been started with the crisis were not completed, as we've just heard. That's true of the EDIS, but that's true also of different other reforms that were being performed, such as the Commission's December package, etc. And this was due to the fact that I think the sense of urgency that we felt during the great financial crisis was gone, and now it's back, and well, basically we have to decide very soon and very fast. At the same time, we're also in a different situation because we've had Brexit, which means that, well, not only do we need to, well, define the future relationship with the UK, but also the balance between Eurozone and non-Eurozone has changed, and dramatically so. We've seen in the last weeks, Bulgaria, well, speeding up the process of joining the Euro area, and well, we can ask the question as to whether more member states will be able in the future to remain outside of the Euro area. And I think eventually, well, this has a big role to play for both the banking union, which is likely to, I think, probably be equivalent in terms of membership to the Euro area, and the balance overall within the EU. So that's a bit to the background. Now, like I was saying, the way in which the reforms have been performed is, well, very different from what happened the last time around, not only because we worked remotely, but also because of the actors involved. Whereas during the great financial crisis, we had a key role of the European Council. We now see, at the peak of the crisis at least, it's likely to be different with, well, the MFF and Next Generation EU, etc. But we see really a key role of the Eurogroup in inclusive format. And I think this is really a peculiar point to make in the sense that, first of all, well, probably the legality of this organ, well, informal forum or whatever we want to call it, should be questioned. Its suitability should also be questioned. At the same time, it's worthy to note that, well, we've gone down from the level of heads of state to the level of ministers, despite the fact that, well, we've been adopting very far-reaching, reforms in a very short period of time. So maybe that also is a sign that, well, we are heading towards a common path within the union. Now, the issue is not only, I think, one of legality, but it's also one of scrutiny, because from the moment that you have this, well, informal organ making so many decisions, it's only in few member states that you have, well, adequate parliamentary control. And now, if you look, for instance, at the form of the instruments that have been adopted so far, taking the example of SURE, for instance, despite, you know, the fact that I think it cannot be debated that it's a leap forward and it's a sign of solidarity among member states, etc. You had no involvement whatsoever, neither of the European Parliament nor of national parliaments. So, you know, and that leads me perhaps as a point for future discussion to say, well, I think it's very difficult to now assess whether we're moving towards a more intergovernmental EU, in the sense that we've reactivated the, well, an ESM credit line, and despite other instruments being available. And at the same time, we have these clear signs of, well, solidarity in EU, you know, borrowing on the markets with Next Generation EU, SURE, etc. So I think the balance, contrary to the previous crisis, which was much more intergovernmental with the approval of the fiscal compact and the ESM treaty, etc., is a very different one. Now, well, moving on perhaps to my last points, I think I'm running out of time, but maybe to try and open a little bit the discussion. I think the next question is, in terms of banking union, to go back to the topic of today's webinar, but also in terms of EMU governance and EMU rules, how, you know, this COVID crisis is going to affect the reforms that were already underway. We've seen, well, so many difficulties in trying to approve the reform of the ESM treaty, which was finally almost there. And then, well, we had the issue with Italy, and now we have the COVID crisis, etc. And yet, I think it's fair to say that the ESM has also changed its purpose through the, well, the fact that it provided this credit line for the pandemic. So I think, yeah, this is a clear open question. And the next one, perhaps also for discussion, is how are we now going to administer those funds? Because should we as Europeans, and should they, well, perhaps primarily the Commission, fail to deliver, that would be dramatic. In some countries, it's already been difficult to prove, well, this Next Generation EU and its temporary character and the exceptional character, etc., have been stressed so much in some of the member states. Now, do we need an EU treasury? Are we satisfied with the proposals that have been made to use the existing programs of the Commission, despite, you know, the shortcomings that exist in certain member states in terms of administration? So yeah, this is a little bit more food for thought than really an analysis, but thank you very much.
I'm actually going to have to jump on that one. And also what you were mentioning before about the nature of the intergovernmental structure that somehow they used moving into the question of the Eurogroup, which was openly said by the Court of Justice that it doesn't exist as a thing. So that's very interesting to see how in the end we're seeing a more interleague negotiation between governments and not so much the development of the actual structure of the EU. Because even when we look at SURE, when we look at Next Generation Europe, in the end is actually an agreement between governments putting guarantees to make sure that they can borrow money and then eventually transfer that money, but they want even to be involved in that decision-making process through the council. And now you were mentioning the possibility of creating this treasury that has been mentioned all over these negotiations. How do you see this possibility of understanding that we cannot rely exclusively on intergovernmental negotiations and that we need to have proper structures at European level that can actually deal with these sort of enormous crises, and that they need to do it faster as well, because often the problem with the governmental negotiation is that it gets more difficult, like the case with the ECM and Italy. So how do you see this evolving in the future? Whether it's actually possible that we see something like that happening?
Well, I wish I had a clear solution for you, but if I did, I wouldn't be sitting here. Now, I think, well, in terms of, yeah, what can we learn? And the issue for me is, well, it's twofold, I think. I mean, on the one hand, we have this, the Commission that is, well, experienced in doing these sort of things and has this intergovernmental EU character, or should have, guardian of the treaties, etc. So you could argue, you know, we could delegate or imagine some sort of system whereby the member states would still, well, give their input, but it would be eventually be implemented by the Commission. At the same time, we have, I think, the other model of the independent institution in the form of the ECB, where basically, well, the national interest, at least on paper, should not be there. I think it can be discussed whether this is still the case, but you know, where you have an independent organ, etc. Probably for me, the biggest challenge is the fact that within the EU, we operate in a treaty that we cannot be reformed so easily. And then, you know, we need to be careful not to put ourselves into too much trouble by fixing the rules into the treaty framework that, you know, then we cannot amend so easily. So Yeah, to go back to your question, I think it's undoubtable that for me, the solely, going forward or continuing the way we've been operating will not be successful. I mean, with those, yeah, like I was mentioning before, programs, etc. I think we need somehow another form of supranational guarantee, at least that the member states have the capacity to administer those funds, because we don't want a case that they even administratively practically cannot use the funds. And I think this is what is the case in the member states that most need it. At the same time, I don't think we're yet to the point where the member states are just going to agree to having one EU agent. So I think we need to try and come up with some sort of hybrid solution, maybe looking at what's going on in agencies, or not saying we should create a new agency, but or other instances of coming together.
So you finding some solution in midway, which is often the case. Thank you very much. Before we jump into the discussion, I would like to introduce Giuseppe Russo, who is actually the other co-author of the Banking Union report presented by the European Liberal Forum. So he would like also to say a few words about the report. So I don't know if he's ready. Can we? Yes, I'm seeing him now. Okay, so Giuseppe, please, you have the floor.
Okay, now it's in unmute mode. Thank you to everybody. The discussion has been very interesting, and also the speech of Graham Bishop and Diane Fromage. I have 2 points to stress. The first one is that we are speaking about, we are treating about a possible banking crisis that is absolutely new in terms of the origin. We can, because when the European banking system has been projected and then developed, we were pointing at the banking crisis that could spring out from mismanagement or by over leverage and normal macroeconomic instability factors. Now we have a possible crisis that could spread in all the European Union with effects that cannot be isolated from one country to another one. So we have to be very cautious in the forecast and also in the solution. About the forecast, we cannot be sure about the exit of our COVID crisis and the effect on the banking system for 2 kinds of reasons. First of all, we are not certain about the kind of the recovery, if it will be a V-shaped recovery or a recovery that could take more time, several years to go. In this second case, we certainly will be more close to a structural banking crisis that could spread out. The second question is the role of inflation, because we now are in a situation of quasi-deflation that come from the demand side. The demand level, the aggregate demand level is so low that prices level are not excited. But on the supply side, we injected in the system a huge amount of liquidity, and we encouraged the enterprise, the firms, and also the government to issue a lot of new debt. And this situation is potentially a situation very dangerous for the inflation. And so we are now facing about two sources of uncertainty. The first one is the time to recover that will occur in the next months or in the next years, and the second is the possibility that the potential of inflation that we injected in the system in order to finance the recovery by issuing new money will put in serious trouble the European banking system. So I think that in terms of policies, governments and the European institution should have a B plan in case the A plan that is based by the pandemic program and is based on the next generation EU fiscal program will not succeed, and in case we the European Union will incur in a scenario of prolonged crisis and potential inflation. So in order to I want to add these two questions to the discussion to the panelists, and so I want to hear from our excellent speaker your opinion about these two issues. Thank you, Beatrice.
Thank you very much, Giuseppe. Then I'm going to give the floor to both Graham and Diane to respond to the comments from Giuseppe that I think it fits very well into the conversation that we were having. So please, Graham, maybe you can jump first.
Yes, absolutely. Giuseppe's point is very relevant about the inflation potential. When we're creating this monetary cloak, the ECB is buying government bonds. Bear in mind that one of the prohibitions in the Treaty of Maastricht was indeed that the central bank mustn't provide monetary finance. It hasn't provided monetary finance by the letter of the rules, but when you look at the practical effects, it's about the same thing. So the risk is clear. Now, just to think for a moment about what might happen, if these new next generation bonds, which are AAA safe assets, the safe assets that banks have been asking for all the time, if the banks go out and buy very long dated bonds, if they were to do that, funded by household deposits for under 2 years or overnight deposits, we get a dose of inflation. And we don't have to talk about massive inflation, but 5 and 10%, which many of us can remember very, very easily, not that long ago. Then interest rates will surely go up and bond yields will surely go up. And at that stage, the refinancing costs for the banks will rise relative to their bond holdings of fixed income. And they will have a fundamental problem, which will not go away for 30 or 40 years. So this is a very dangerous scenario if the banks buy these bonds. One of the points I made in our paper was about the need for a European Treasury, to pick up Diane's point. And that is not a long-term bonds, but short-term money market type funds up to maximum of 2 years. And this is one place where the US Treasury issues vast quantities of liquidity. And I forget the value, it's about 5 times the size of the European short-term paper market. And that's the foundation of the dollar's international role because it is the store of value for anyone who wants to hold liquidity. If we want to do something comparable, which we could, we would need to combine the issuance of all the European governments, all of them, not just Germany and Next Generation, in a single instrument. And that we could, on my calculations, fairly easily get up to $1 trillion or more, which then becomes a real rival to the dollar, but does provide the safe asset for banks, which is matched by their deposit structure. So I think there are several reasons for wanting to have a genuine European treasury, one of which is the survival of the banking system, banking union we're talking about, but also to give an asset which all European citizens who want to save, as they do, for their retirement, they can hold both shorter term European treasury bills, but also next generation longer term bonds. So there are several reasons for a European treasury to come into operation. And I feel that this is the moment where we need to think about that again. We've gone in for next generation and the long-term stuff. Don't forget the short-term stuff as well.
I think it's very interesting the point you made, because there has been a big discussion as well about the role of completing the banking union to make sure that you can have an international role of the euro, which has been one of the priorities of the Commission.
Yep.
So if you don't complete that part of the picture, it's very hard that you could actually get to have the importance in the monetary market that the dollar ever had. I'd like to give the floor to Diane as well, if she wants to give us a word.
Yeah, no, thanks very much. I unfortunately cannot speak so much to the economics of the aspects that have been touched upon by Giuseppe and Graham, actually, in terms of inflation and the shape of the recovery. Now, this being said, I think these are characteristics that call for, well, a specific way to manage the crisis. And I think because, as Graham was touching upon, we now have an ECB that is buying on secondary markets, etc., which is, well, to the border of what the treaty allows, let's put it this way, and has given rise to important problems, in particular with the German Federal Constitutional Court. Now, so on the one hand, I think the issue there is we've had an ECB that has been left, well, at least at the beginning, largely isolated by the member states, and has had to use its instruments to try and safeguard the euro. And with the instruments that have been adopted so far, well, by the member states, we see a certain, well, move forward or an improvement with respect to the previous situation, but it's not going to be enough. I also think we've seen a tendency towards renationalization of the ECB and especially the national central banks. And yeah, I'm not sure how this can be enforced, but I really, yeah, I'm deeply convinced that one of the issues should be that, well, those involved have to think in terms of a European interest and not necessarily a national interest. And that's also, yeah, if you look at the parliamentary debates around shore, etc., with all those safeguards that have been imposed or had to be adopted for such an instrument to be agreeable to parliamentarians, it is in some way worrisome. And my concern is, and that goes a little bit to this idea of the shape of the recovery being unknown, is how member states going to react, especially in the so-called frugal states, when the urgency of the crisis is gone. So when it's not this symmetric shock anymore that has been, coming onto all the member states without them having done anything, but when the problems that were underlying arise again, or the differences in which the different member states were affected arise, are the frugals going to be ready to help? And this is along this way that I think we should think, taking into account this particular uncertainty in terms of, well, the shape of the recovery and the inflation.
I'd like to jump on that question, and I will ask you about that. But I would like to encourage the participants that are following the debate today to ask questions. So if you have questions, you have a chat box, you can leave it there, and I will ask our panelists. So I wanted to jump on what you were saying, because you both have said how, first of all, we're facing an unprecedented economic crisis. This is going to be a long-term shock. It's not something that's going to go away. And I was thinking that you know, you were mentioned now, what happens when the big shock is over? We are potentially facing a debt crisis because most of the tools that we have already on the table are not necessarily only grants, but also loans. A lot of member states are indebting themselves to try to pay the cost of supporting their economy, keeping the jobs. I remember that one of the big issues when we were discussing the completion of the banking union, and particularly putting together EDIS, which has been there forever, was the question of how can we enter into risk sharing when we have some member states with incredibly high numbers of debt. So we are getting into a way worse position in a way, and we need that system more than ever at the same time. So how do you envisage this political discussion? Did we lose political momentum back in the past few months when we had the chance to complete this? Are we getting into a way worse position, or precisely because we're facing a much harder situation, member states might be more open to definitely complete the banking union and make sure that they have a support system in case of a crisis like the one we're facing today? You can maybe start, Dan, and then we can go back to her.
Should I respond? Yes, right. And the question of risk sharing, I think this is very interesting because that's what it's all about. And in the end, does Germany and the other top credits, do they want to share their credit with countries who've not got such a good credit for due to debts incurred in years gone by, shall we say, or decades gone by? And that's what's so interesting, the difference between the response to Greece, which was, I said, 2% of GDP, and this time it's the whole of Europe. And so the next generation, the governance, which Diane has talked about, that is such a critical change. Now, there was a question from Julius Larcher about what this European Treasury that I'm talking about, what that might look like. Is it the finance ministry? And the answer is no, it isn't. We need here to be very, very specific about functions which in many nation states have been specific economic functions, have been bundled up and put in different buildings and different names. I always like to think of the Treasury as being, if you go to the Riksbank in Sweden, you will find there a very fine chest with many blocks and things in which they used to put the gold. That was the Treasury. There is the chest, and in there were the gold coins. So that's the Treasury. Who has control of that? Who takes the liquidity out? Who puts it in? Separate question is what set of spending rules and what set of taxation and who enforces it and how? How does the money get in there and go out? So those are two quite distinct functions. And I'm not for a moment suggesting that that finance ministry function of single set of taxes, single spending rules, spending controls over excess spending, that's inherent in the Treaty of Maastricht, of course. So we're not going to change that. Maybe a greater control, but the European semester is already there to provide that European oversight of economic policy as a whole, the economics ministry as well as the finance ministry in many countries. But the Treasury is a very simple thing. It is the chest, to take the picture, in which you put the gold coins and then you take them out. And how do you control that? Who organizes the money coming in and going out, the physical manifestation of it? That's the Treasury.
Maybe the end you can jump in on the question of whether we are creating momentum to have the completion of the banking union, in particular case in the EDIs.
Yeah, thanks a lot. So first, yeah, footnote, I fully agree with your idea of Treasury. So this is also what I was mentioning. I think, well, I'm not sure the European semester has been as successful as we would have liked it to be, but in any case, indeed, this is what I had in mind. Now to go back to the momentum, again, it's not an easy question, but I would tend to think that yeah, given the breadth of this crisis, we will be forced to move forward. And if you look, I think there are different tendencies that will help us do this. If you look at, well, for instance, the change in the economic culture in Germany, etc., that should try and, well, or participate to us being able to agree on this. And perhaps also the UK leaving will help the rest of the member states. Now, this being said, it's also a problem, I think, of, well, or at least a time in which we're going to have important elections coming up. So I would think that depending on the outcome of the German elections that are coming up, you know, it's going to be possible or it's not going to be possible. And like I said before, I think it will be absolutely decisive and crucial to see how we now act in the next month. So I would tend to think that even though, you know, lots was done during the peak of the corona crisis at the EU level, it wasn't always clear to citizens, especially in some of the more Eurosceptic member states, what the EU is doing. And, you know, if you don't get your citizens on board in the next months, it will be very difficult to pass those reforms, especially those that will require a treaty change, be it, you know, intergovernmental treaty or be it an EU treaty of some sort. So I think, you know, this is, so yes, in short, we're in a momentum, but we need to seize the moment.
I think it's very interesting that you mentioned the question of getting the citizens on board precisely in a moment where we see that the EU has acted relatively quickly compared to other crises, and also that the perception and the message that Brussels was saying is that this is an historic moment. You mentioned the changes in Germany. It was definitely something that would have never expected to have Germany on board of issuing common debt, and now we're getting there. So eventually we could have that kind of movement at political level. I'm going to take a question from our audience. It's actually quite a long one, so there are a few questions inside that question. I'm gonna try to bring it to you. So it's to Graham, but I guess you should all be able to answer this one. So even before the current emerging crisis, the proportion of non-performing loans and loans losses on the books of the banks, especially in the case of southern member states, was quite high. Considering this, it seems the problem is on the deeper level, affected by low business activity, low relative productivity, etc. Given these, are there any tools, mechanisms to cope with these problems? And second, what do you think about lowering capital requirements, risks? What about increasing market financing share versus banking? I think particularly the second question is very relevant, considering that's one of the first decisions that the Commission took in the middle of the crisis. So maybe Graham, you can jump in first.
Yes, and just to deal quickly with the first part, dealing with low productivity, etc. This has been what Europe has been trying to do for decades. This is what the European semester was all about, etc. Yes, of course we must do that. Are we going to do it next week? No chance. So let's push on with the good work, but let's not hope for a sudden miracle. So let's go to that second part about lowering capital requirements and market financing, capital markets union versus banking union, to put it in current jargon. Lowering capital requirements, that's what the ECB has effectively done by saying it won't require banks to take action when their Pillar 2 guidance level falls, but at the Pillar 2 requirement level of CET1 or Tier 1 capital ratio, they are obliged by CRD to act. So the only way we can change that is a change in primary legislation, which can be done. Of course it can. It takes time, it takes an amount of time, but that is a huge step. In the middle of a crisis, to deliberately decide to allow banks to operate with lower levels of capital, if then the worst happens and it's a long drawn out recovery and these loan losses become as bad as I fear, then the banking system is bust. And if you have, as the public, the European public, you have decided very specifically to lower the capital requirements, to lower the amount of capital in the banking system, you have taken collectively a responsibility which you will then have to fulfill to your citizens. That is a very profound change, and that will take some discussion, shall I say. Market financing, CMU rather than banking, of course. That's the whole idea of CMU. It has been for 5 years. Are we getting there? No, we're not really, sadly. But overwhelmingly at the moment, banks are the main providers of, I think it's 80% of new credit comes from banks. So let's keep pushing ahead on getting CMU, and the Commission's just come forward with some new quick fix tweaks. Let's do those. Yes, they're sensible, particularly securitization and so on. Let's do them. But again, let's have no illusions that this is going to solve the problem in 6 months. If the equity market is at all right in that halving of bank shares from already astoundingly low level to 40% on average of their book value, there is a crisis at hand which we don't have 6 years to fix.
Thanks a lot for that. I think it's even a very nice thing as a closing remark of all the challenges that we have ahead. Maybe then you can jump in. We're running out of time, so I think it's also if you want to think about a last reflection on the conversation that we've been having this morning, that'd be great.
Yeah, thanks very much. I'll keep it short because, yeah, I don't have much to add to the NPLs, etc. Yeah, just to go back to what we were saying, I think I would try and, yeah, hope that, you know, we're going to be able to implement those changes rather fast. And yeah, like I was saying, that maybe, you know, our member states representatives are trying to, well, yeah, exercise their powers in the best of the European interest. And also, I think that we're going to see an effort from, you know, well, parliaments and representative organs also in the south of Europe to try and, you know, explain what's going on, because we witnessed that whereas there's been a lot of debate in the frugal states, the others just haven't been bringing this to the public. And I think, yeah, that's my wishful thinking for today. Thanks very much.
I think probably the only country where there has been a debate was in Italy about the reform of the ECM for whatever reason, and it got very technical and very strange. But yeah, I just want to, because there has been a couple of questions about your position on the modern monetary theory, and I don't know if any of you want to jump in before we finish for today. Otherwise, I'm going to close the debate for now. I would like to thank you all very much. I think we can clearly see that even though we've been aware of the urgency of completing the banking union for quite some time, it seems more urgent than ever. But at the same time, that we see some movements at political and technical level at the European Union that keeps a little bit of hope and make sure that we can move forward in the next few months, because we don't have years to finish to solve this, Graham, as you said. I would like to close by presenting the next episode of On the Agenda that would take place the 9th of September, and it will be on the platform regulation. As we are now aware, the platform economy it's becoming increasingly relevant in this economic system right now, but we definitely miss a lot of regulation when it comes to these kind of companies, and the European Commission has been putting forward quite some initiatives to shape how the platforms work within the European Union. So that will be the discussion for the next time, and I would like to thank you very much, all panelists, for today's discussion. It was definitely very interesting, and all the people who attended either through this Zoom event or through our social media, thank you so much, and I hope to see you soon in the next debate.